When people hear the number $50 million in real estate, they usually imagine one major, massive skyscraper in Manhattan or luxury high-rise somewhere in a major city. But the reality of commercial real estate is much more interesting than that. $50 million can look completely different depending on what asset class you choose, what market you invest in, and what strategy you're trying to execute. In fact, the same $50 million could buy you a single building in one city or entire portfolio across multiple states. It could produce conservative long-term income, or it could be positioned for aggressive appreciation. So today, I want to break down what $50 million in commercial real estate actually looks like and how investors typically allocate that capital, how prices vary across different asset classes, and where the opportunities are depending on what you're trying to actually accomplish. We'll look at the major sectors like industrial, multifamily, retail, and office. We'll talk about how the cap rates and cash flow vary between them. We'll look at where prices are highest and lowest across the country. And by the end of the video, you'll have a much clearer picture on how flexible commercial real estate investing can actually be. Let's start with one of the biggest misconceptions. Most people assume that large commercial real estate investors put all their capital into one deal. In reality, most institutional investors and family offices prefer diversification. They spread capital across multiple properties, multiple markets, and multiple asset classes in order to balance the risk and return. So if someone had $50 million to invest in commercial real estate, one possible approach would be diversification across several sectors. For example, part of the portfolio might go into industrial properties, another portion into multifamily housing, and another into retail or mixed-use properties, and possibly some into value-add opportunities. Let's look at how that might break down. One common strategy right now is allocating a large portion to industrial real estate. Industrial has been one of the strongest performing asset classes over the past decade, and largely because of the growth of e-commerce and logistics. Warehouses, distribution centers, and last-mile logistic facilities have become incredibly valuable as companies compete to deliver products faster and more efficiently. Across the United States today, industrial cap rates typically range between 5 and 6% depending on the market. That means a $20 million industrial property might produce roughly $1 to $1.2 million in annual net operating income, or NOI. Markets like Dallas, Atlanta, Phoenix, and parts of the Midwest often offer slightly higher yields compared to the coastal markets like Los Angeles or northern New Jersey, where prices are much higher, but supply is limited. If an investor allocated $20 million of that $50 million into the industrial properties, they might own 2 or 3 distribution facilities, producing stable long-term income with strong tenant demand. Next, let's look at the multifamily housing. Multifamily is another core asset class because housing demand is extremely consistent. People always need a place to stay and live, and that stability is why many investors consider multifamily to be one of the safest sectors in commercial real estate. Cap rates for multifamily today often range between 4 to 6% depending on the market and the class of the property. A $50 million multifamily property in a growing Sunbelt market might generate roughly $700,000 to $900,000 in annual net income, depending on the occupancy and rent levels. Markets like Texas, Florida, Tennessee, and Arizona have attracted massive population growth over the last decade, which has driven strong multifamily demand. Meanwhile, high-cost states like California, New York, and New Jersey often have much higher purchase prices, but sometimes lower cap rates because of the supply constraints and high barriers to develop. So if someone invested $15 million into multifamily housing, that might represent a 100 to 200 unit apartment complex community in certain parts of the country, producing stable rent income and long-term appreciation. Now, let's talk about retail because retail often surprises people. Retail real estate went through a major shakeup during the rise of e-commerce, and many people assume it was dying, but what actually happened is the weaker retail properties disappeared while stronger locations became even more valuable. So grocery anchored centers and service-oriented retail and well-located neighborhood shopping centers remain extremely resilient. Think about the types of businesses that cannot easily be replaced by online shopping. Restaurants, fitness studios, salons, medical offices, coffee shops, which I absolutely love, and everyday services. Retail cap rates today often range between 6 and 7% depending on the tenant mix and the strength of the location. That means $10 million invested into retail could potentially produce $600,000 to $700,000 in annual income. And this is where geographic differences really become interesting. In major coastal cities like Los Angeles, New York, and Boston, retail spaces can easily sell for over $1,000 per square foot in prime locations. Meanwhile, in parts of the Midwest or Southeast, that same type of retail property might sell for a fraction of that price. So depending on where you invest, that $10 million could represent a small urban storefront portfolio or an entire neighborhood shopping center anchored by national tenants. Now, let's talk about one asset class that has gone through one of the biggest transformations in recent years. Office space. Office real estate has really faced serious challenges since the pandemic as remote work and hybrid work models changed how companies use space. Many older office buildings have struggled with vacancies, especially in downtown areas that depended heavily on daily commuters. Because of that shift, office prices in some markets have dropped significantly, creating opportunities for investors who are willing to reposition or redevelop those properties. Office cap rates can range widely depending on the building quality and the market, and sometimes they're ranging from 7% to even double digits in distressed situations. So if someone allocated $5 million towards office investments today, they might be targeting value-add opportunities. That could mean repositioning a small office space and building, converting it into a medical office, or even exploring redeveloping it into residential units. What's important to understand is that each asset classes, they serve a different purpose within a portfolio. Industrial often offers strong demand and stable tenants. Multifamily provides consistent housing income, and retail can generate higher yields and strong locations. And office, while more volatile right now, may offer long-term upside for investors willing to take on repositioning opportunities. But beyond asset classes, geography also plays a massive role in how far $50 million can go. In major gateway cities like New York, San Francisco, or Los Angeles, real estate prices are extremely high due to the limited land and strong long-term demand. In those markets, $50 million might purchase a single mid-sized building. In contrast, in growing secondary markets like Nashville, Charlotte, Indianapolis, or Kansas City, that same $50 million could acquire an entire portfolio of properties. These secondary markets have become extremely attractive to investors because they offer stronger cash flow and population growth while still benefiting from major economic expansion. Another important factor to consider is appreciation. Over the past decade, industrial real estate has been one of the fastest appreciating asset classes due to the explosion of logistics and e-commerce. And multifamily has also seen strong appreciation driven by housing shortages and population migration to lower cost states. Retail, particularly experimental and service-oriented retail, has stabilized and even rebounded in many markets. Office remains more uncertain, but that uncertainty is also creating opportunities for investors looking for discounted acquisitions. So when you put all of this together, you could have $50 million that look completely different. It could be 3 industrial buildings producing long-term lease income, a 200-unit apartment community providing stable rental cash flow, a neighborhood retail center anchored by strong tenants, and a smaller value-add office project positioned for future redevelopment. Instead of one single asset, it becomes a diversified portfolio designed to balance risk and income and appreciation. And that's really the key takeaway here. Commercial real estate investing isn't just about buying buildings, it's about building a strategy. The right portfolio depends on your goals, your risk tolerance, and the markets you want to be in. If you're looking at commercial real estate and trying to understand what opportunities might make sense for you, that's exactly the type of conversation we have with investors all of the time. If you'd like to explore what a portfolio strategy might look for you, there's a link in the description where you can connect with me directly. We can talk about your investment goals, the types of properties you're invested in, and how commercial real estate might fit in your broader strategy. Because as you can see, $50 million in commercial real estate doesn't look like just one thing. It can take many different forms depending on the strategy behind it. And understanding that flexibility is where real opportunities start to appear.